Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, January 26th, 2022, and I'm pre-recording this Trading Places Live for Thursday, January 27th. Oh, it was a wild day today, and currently futures look like they could start off a little wild again tomorrow. Dow futures currently down 320 points. S&P 500 futures down nearly 50. NASDAQ futures down just over 200. Who knows? This is, like I said, Wednesday evening. Who knows where futures are going to be in the morning, where the market's going to ultimately open. It was a wild day today in the market, and we're going to get into all of that in just a couple of minutes. Let's go ahead and start off with today's agenda. So we're going to get into the daily market recap, go over a little bit of the wild action that occurred on Wednesday. Then we'll get into talking technically. Then I just want to do a segment called inflation, and just look at a couple of the components or the criteria, some of the things that the Fed looks at, and you be the judge, whether or not inflation is going to be or will continue to be the problem that it is currently. Anyhow, we'll go through that. Then we'll get into the earnings spotlight. And we'll wrap up with the three you must see. Before we get into any of that, though, for those of you that are new to me and earningsbeats.com, let me just take you over to our homepage. Really offer up our free newsletter to you. If you'd like to subscribe, all it takes is a name, email address, hit that subscribe button. When we do free events, we usually have huge attendance. We got a lot of folks on this newsletter in the tens of thousands, and love to have you join. I publish a newsletter Monday, Wednesday, and Friday. When I say newsletter, it's really just a quick chart and a couple of paragraphs. So it's a very easy read, and it's 3 times a week, like I said, Monday, Wednesday, and Friday, talking about earnings and gaps and relative strength, candlesticks. I mean, things that are important to us at Earnings Beats. So I think you will find it very educational in nature. But all you have to do is just go in and type in your name, email address, and we'll get that started for you. All right, let's move on to the daily market recap. And what a day it was. Wow. At 2 o'clock, you probably would have never been able to convince me that we were going to finish down on the Dow and the S&P and almost on the NASDAQ. Also, we saw down action on the mid caps and the small caps. We were up significantly at 2 o'clock, and then the Fed announcement came out. I could just go on a big rant, and I'm sure I will during this show today at various points. I think Powell screwed it up. I'll just be honest. I think that he had an opportunity. With the pandemic, there's so many question marks with this pandemic and how we're coming out of it. And, nobody's dealt with it before. There's no prior Fed chief that's had to deal with a pandemic. We're talking about back before the Federal Reserve was even created last time we had a pandemic. So there is no rule book for dealing with a pandemic. I think the Fed would be much better suited just doing what it did last year, which is, hey, we're watching things. We're watching things evolve. We don't know, how this is going to play out. We believe it's transitory. I think just changing the language and saying, hey, it's not going to be months. It might be a couple of years, but we're still working through supply chain issues. I think the Fed had lots of outs rather than to go down the road and say we're raising rates and that we want to make sure that we've got inflation under control. We don't know how much. First of all, the economy, in my opinion, is not driving inflation. I don't think we've got this tremendous demand outside of the increased demand because we're coming out of a pandemic. And the fact that supply is already limited. We've got supply chain issues that we've talked about. Everyone knows about them. That's what's driving prices higher. It's economics 101, but it's not something structural in our system. It's not the economy overheating. It's coming out of the pandemic. Anyhow, I'm going to stop right there because I got some other things I want to talk about later. But you can see the Dow Jones Industrial Average finished down 130 points. It was a wild swing. We were up several hundred points during the day and then gave it all back and finished in negative territory. The S&P 500 finished down 6 points. It was well over 4,400 intraday, probably up close to about 4,460. I don't remember exactly where it was, but we came back down, closed at 43.49, just under 43.50. So big move off of that intraday high. The NASDAQ was up, I think, 460 points at the high, then went down about 150 points, then rallied back right into the close to finish up 3. It was just, crazy, and get ready for it, because I don't think we're done with this craziness and this wild behavior. I said before the year even started, I was talking about this, saying this is going to be a wild roller coaster ride. And thanks to the Fed, they're pretty much going to guarantee it, because we're going to have inflation news. We're going to have higher interest rate news. We're going to have some good earnings news that are going to kind of offset it. And the market's not going to know which way to go. And so we're going to have these big moves back and forth. But ultimately, the threat of inflation and the threat of higher interest rates, I believe, sends the market lower. So we're going to have to be on our toes and ready at any moment for another, just waterfall, watershed, whatever you want to call it. We're going to have some of those moments in 2022, and just hope we're not caught on the wrong side of it. Mid caps finished down 25, small caps down 19. So just across the board, big reversal off those earlier gains. As far as the individual sectors go, technology and financials, those were the only two that finished in positive territory. Technology, thank goodness, right? I mean, how much more pain can that group take? It was up at 175 to start the year. Just a couple of days ago, it was down to about 146, all the way down, testing the lows from back at the beginning of part of October. And we have rebounded off of that somewhat, but the lows, in my opinion, for the year, not even close to being in at this point. Financials did rally up about 0.25%. We saw the treasury yields moving higher after the Fed meeting, and as a result, financials did do pretty well on a relative basis. Real estate, not so much. Real estate down 1.7%. Communication services, this group just can't catch a break right now, down 1.5% almost. And materials down over 1%. So 9 of the 11 sectors were down on Wednesday. Only technology and financials able to finish in positive territory. Here's the 10-year treasury yield. So we did jump up to 1.85%. So that was 6.5 basis points higher. Didn't get a breakout, but probably just a matter of time. Maybe we'll see it on Thursday. I see yields going up. I don't know how or why you wouldn't want to sell bonds at this point, given the rhetoric coming from the Fed, given, the higher inflation numbers that we truly are seeing. And I always like to point out, I'm not trying to say that there are no inflationary pressures. When I talk about no inflation down the road or whatever, it's not that there's no inflation. There's inflation. I mean, you see it everywhere. But I don't think it's going to last. I think it will naturally come down somewhat. And I think we're going to see it in the numbers starting around April or May. I think we're going to start to see the core CPI come down. Now, Fed's worried that it's going to, we're going to continue to have pressures ahead. Well, yeah, we're going to have pressures for the next 2 or 3 months. I agree with that. But if you look at the numbers, I think we start to come down in April or May. And if that's the case, I'm not sure there's a need to be raising rates, but all right, call me crazy. And feel free to disagree. This is going to be a wild topic, highly debatable throughout the year. You're going to have some thinking the Fed is making a big mistake by raising or threatening to raise. Others going to be thinking, hey, you should have been doing this a long time ago. People all over the map. And I'm certainly not saying I'm the one that's right, but I do have my opinions, and I'm happy to share them. All right, let's move on to talking technically. So the S&P 500, this is the daily chart. You can see, I believe we've got a head and shoulder top. And ordinarily, I wouldn't point out a topping pattern in a secular bull market. I usually say, no, don't do that. It's premature, because in a secular bull market, we tend to keep going higher, and those topping patterns end up being eliminated. They're not worth anything. They're not worth the chart that they're printed on. But in this case, I see so many warning signs, and I think the Fed is adding fuel to the fire right now. So I see the market going lower. And as a result, I do see this as a left shoulder, neckline, head, right side of the neckline with a lower move intraday. That gives it a little bit more of a bearish flavor as far as I'm concerned. And then I thought we'd probably come in and put in a lower right shoulder. I thought we'd get to 4,500. And we got to 44.50, I think, on 44.53 on the S&P. So we didn't quite get up there. I figured 4,500 to about 45.50 in this range would have been kind of the top, not expecting to get above this high over here on the left shoulder. But I'm not sure, we haven't peaked. We'll see how things go tomorrow. I mean, now with the Fed out of the way, we should be in for a relief rally. But the Fed's kind of played its hand. So I don't know if this leads to another big drop or not. But a move back to 4,500, 45.50 in that range, to me, establishes a very solid right shoulder. So that would kind of be, if you're looking to short, you're looking for the best possible area to short. To me, that's it. Because if it gets much through, through 45.50, certainly 4,600 gets back up through both of these levels where it broke down from. That would be, starting to paint more of a sideways consolidation picture as opposed to a downtrending picture. So I would watch that 20. I mean, maybe the 50, but I don't think we get back up to the 50. I'm not even sure we get back up to the 20, to be honest, at this point. But if we go back down and we lose that low that we saw back on Monday morning, then I think we are heading into the 3,000s. Probably on that move. So you got to be careful in this market. I've been saying it for a while. I think you really have to be careful. For me, I got stopped out of gold. I had gold today. Gold took a big hit after the Fed meeting. Again, with the Fed being way more hawkish than I think they should have been. I do think gold bounces back, but I'm not going to just sit in it and wait for it to bounce back. It's got a kind of a triangle pattern I've been talking about. It could go to the bottom of the triangle, which could be another few dollars. I just don't want to ride it. So anyway, I took my lumps there, got stopped out of gold, and I'm just sitting on the sidelines now because I don't trust anything. I think the market, like I said, we could go up and put that right shoulder in. We could easily see the S&P 500 up. I'm going to say up maybe 200 points, possible. But I could also see a breakdown coming at the end of this week, which, would be down a couple hundred points. I don't know which way it's going to go in the short term. All I know is that I don't like it. I think it's going to go lower in time, and I don't need to be a hero and try and catch every single intraday move back and forth. That's an exercise I'll let everyone else try to figure out. When the volatility index is where it is right now, I think that's a really difficult game. So let's move on here and talk a little bit during this segment about, I just want to compare 2018, the fourth quarter of 2018. This is an hourly chart from June 2018 to the end of March of 2019. And it was right here, and I can annotate and I can show you right where the Fed, and I could talk about this for a while. So this is going to be hard to squeeze all of this into a one show here. But right here is where the Fed infamously raised rates and said we got 2 more rate hikes coming potentially in 2019. And I remember seeing the market collapse. I wrote an article right down here somewhere around Christmas time and said how the Grinch stole Christmas featuring Jerome Powell, and said there's no way we're going to have 2 rate hikes, just in my opinion. And it turns out that when we got to July of 2019, they actually lowered rates. The Fed lowered rates. They never raised again. So this was them. This is them telling the market, which had already been falling, by the way. And there's many who believe, myself included, that the stock market's probably the best leading indicator of our economy. And so when you see the market falling like this is something the Fed should be at least thinking about. And I know there's some of you out there that are like the hogwash. The Fed shouldn't be doing anything based on the stock market. It shouldn't be propping up the stock market. Well, I mean, the stock market does have an impact on the economy. When the stock market's falling, you've got to be aware of that. So I would disagree with those who say the Fed shouldn't pay attention to the stock market. I think the Fed absolutely should pay attention to the stock market. It's a great indicator, leading indicator of what's going on in our economy. Anyhow, after the Fed made that announcement, we were sitting at about 25.80. And 1 week later, we were down to 23.50, almost another 10% down. So we were already going down. The Fed made their blunder. Market got, hammered another 9%. Then we started making our way back up. Now, there were a couple of differences now versus back then. I want to show you, because I'm always talking about how look under the surface. Don't always look at what's going on just at the S&P 500. It doesn't give you the whole story. Back in December of 2018, as we were moving lower, higher, then lower. See how we're moving here? Look at growth stocks, large cap growth versus large cap value. As we were moving down and reaching this low in November, basically an equal low there, notice how the large caps were underperforming. But as we made this next steep decline, we never put in another lower low. Money was rotating back toward large cap growth versus value while the whole market was falling apart. Look at mid cap growth versus mid cap value. Same thing. See these two lows? Just like these, much higher. Wall Street's moving into growth stocks while the market's getting hammered to the downside. And I'm sure if we went back and looked, a lot of those Wall Street firms were probably, had headlines out. Oh, the Fed's going to raise, and that's bad for growth stocks. And then on the other side, they're buying growth stocks. It's the way the market works. XLY versus the XLP going down, down, down. All of a sudden, these two lows, or the two lows here, see how we went down to this low in late December? The XLY XLP was putting in a higher low. Wall Street's bracing for a move back to the upside. Now, the transport did go down to a new low versus utilities. So this is one that continued to move down. But this isn't the one that I usually look at the closest either. This is the one, the XLY XLP, to me, is the best intermarket relationship to look at in terms of determining sustainability in a move in the S&P 500. In this case, it was arguing that that was not a sustainable move to the downside. Prices were going down, but money's rotating back to consumer discretionary. Why would you do that in a market that's falling apart? Well, the market knew the Fed was wrong, and the market came right back. And eventually the Fed got it right. The market turned out to be much smarter than the Fed, which is kind of strange and weird. But anyway, that was the case back then. Now I want to show you what's going on now. Actually, before I show you what's going on now, do you see this move right here in December where we moved back up a little bit? On a daily chart, let me show you what that looked like right here. That was just like this little move. We never even got back to the 20-day on that little bounce before we ended up going even further to the downside. Now let's fast forward to where we are right now. Here's starting back in August of 2021, higher high, higher low, higher high, higher low, higher high, right? That's how we're set up. Look at growth stocks versus value. This is large cap growth versus large cap value. Higher, higher low, higher, higher low. Whoops. Wait a minute. S&P broke out. Why isn't the money going into growth? Well, it's going into value. Why? Because Wall Street saw this coming. Look at the mid caps. We never even got this high back in November. We started seeing issues when the market broke out back in early November, late October, early November. Mid caps weren't following suit. How about the XLY XLP? We topped in November. We topped right here on the XLY XLP. So all this movement to the upside, Wall Street's moving out of consumer discretionary and into consumer staples. Another warning sign. Transports versus utilities topped back in November, early November. So all of these intermarket relationships that we're looking at did not support this move in the S&P 500 to a new high at the end of the year. And that's what I was writing about. I put an article in, I think it was on December 31st, and showed that over the last month, the month of December, the four defensive groups, the four defensive sectors were leading the market to the upside. That's not sustainable. So we were already getting warning signs. You don't have to wait. I made a quote the other day in one of my articles, and I said, you don't have to see a twister in your dining room to realize that a storm's approaching. You don't have to wait to see that. You don't have to see this tornado to realize that the market is in trouble. I was writing about it when the market was sitting at an all-time high. That's the beauty of tactical analysis. That's why we should, CNBC should be focusing 90% of what they do on technical analysis and 10% on all the other crap that's on that station. Anyway, I could go on another rant there, but I won't. Now we're seeing the market fall. Now here's one of the big problems. Notice as we fall, the large cap growth versus value, do you see any kind of a positive divergence showing up here? I don't. Money is continuing to rotate away from large cap growth. How about mid cap growth? Nope. We're actually this bounce came with mid cap growth getting hit even worse, going to new lows. The XLY, XLP, yeah, we came down here and we bounced with the market. Right at the end of the day, we started rolling back over again. We're not seeing anything yet that is suggesting that Wall Street is moving anywhere else except out of all these areas. So you better be careful. That's all I'm going to say. You better be careful because this market is not behaving like a market that is ready just to shoot back up like it has in the past. And I've talked about the sentiment issues. Sentiment still is way too good, if you will. If we pull up the CPCE, let me pull this up and show you. Look at everybody all of a sudden going back into calls versus puts the last few days. There's Monday, kind of just sitting up there all by itself. One day of bearishness, and then options world right back to bullishness again. That needs to change. We need to really start to move this and keep this up into the upper end of this range that we've seen. And again, if you haven't seen this, if I go back last 3 years, you can see that we used to have this range more like in the 0.55 to about 0.80 range. That's where almost all of these readings fell. And then we'd go a little bit up above, and then we'd go a little bit down below from time to time. And then during the pandemic, when everything got so bullish for an extended period of time, we reset, and everybody now is so much more bullish. These lower readings mean that there are more calls being traded than puts. Now we're starting to see that change. We've got to continue it. And you're not going to continue it if the market turns right back around to the upside. The market needs pain, unfortunately. And thanks to Jerome Powell, who I'm going to give him a new nickname, Geronimo Powell, we're going to get that pessimism, I think, in 2022. He's going to make sure of it. Higher inflation, higher interest rates, those two things, we're almost guaranteed to have higher inflation in the next couple of months. I can almost guarantee that based on the way the readings are going to come out and just the way the math works. We're going higher. And now we've got the Fed promising to raise rates in March. I think maybe about the time of that March meeting might be the time that the market bottoms, maybe. But between now and then, be careful. That's all I'm going to say. Be careful. I know I'm going to be taking some serious precautions. I'll trade occasionally, dip my toe in the water, probably get my toe chopped off, get back out of the water. That's probably the way it's going to work. But I'm not going to be a hero. I'm not going to take any major bets. Not at this point. I just don't see anything that's telling me that we're in a bottoming phase. I think we're in a downtrending phase. So anyway, so that was the 2019. There's the 2019 daily. Then of course, this is where we are right now. And here was that chart I showed you earlier. So we never even made it back to the 20-day. Maybe we will. Maybe we get the Fed behind us. Everybody kind of forgets about Geronimo for a few days. Maybe we can get a little push back to the upside. If we do, I would begin to build shorts if that is your inclination. The other thing I thought was interesting, if you go over to the federalreserve.gov site, I mean, you can get the FOMC meetings. And I went back 2018 And December 18, 19, that's the one I was just talking about. If you go in and click on this press conference, you can go forward to about the 17.5-minute mark. There was a female reporter that's asking Jerome Powell, and, he goes through and he's basically saying how everything's kind of on target. The economy's not overheating. It's kind of blah, blah, blah. It's pretty good. Everything looks good. And her question is, then why are you raising? And why are you looking at continuing to raise hike rates? And I thought that was kind of interesting. So anyway, at this press conference, if you go to about 17.5, 17:45 mark, I think that's where it is. And I had to chuckle because I do think this Fed gets it wrong more than other Feds. And I don't trust them. And I think that's part of what's going on with the stock market right now. It's a lack of trust in the Federal Reserve. Now, let's talk a couple minutes about inflation. And I'm going to run out of time here, but I think this is important. Retail sales. Here, you kind of see over the last 5 years, we kind of go up and down around this zero line, retail sales, blah, blah, blah. Here's the pandemic. Whoops, fell off out of the bed. And then, of course, we came roaring back because the numbers, the comparables were so much lower that we had to shoot back up. And then we've had a couple of these little bubbles in here. And now it seems like we're starting to kind of get back to where we were. I'm not seeing any kind of huge numbers anymore in these retail sales. So I don't really get what they're talking about with the inflationary pressures. How about industrial production and capacity utilization? I could spend a lot of time here, but on industrial production, let me just show you that July was up 0.7%, August down 0.2, September was down 1%, October was back up 1.2, November up 0.7, December down 0.1. I'm just not seeing this kind of huge industrial production numbers that make me think we're into this huge inflationary environment. And then percent of capacity utilization. The total industry, this is the average capacity utilization for 48 years, 79.6. Now, what this is telling us is it's telling us how much of our factories, how much are we utilizing? We got a lot of things that we can do, but how much of it are we actually utilizing? 79.6 was the average for 48 years. Look at where we are right now in 2021, 76.2, 76, 75.2, 76.1, 76.6. We're not even at the average capacity utilization of where we were for a 48-year period. And yet somehow we've got these tremendous inflationary. And I pull up one more thing on capacity utilization. This was just a website. And just this one little basic sentence right here. Economists use the rate as an indicator of inflation pressures. That's one of the things that they do. They look at capacity utilization. We're 3 percentage points behind a 48-year average. Where is all this inflationary pressure that we're under right now? I think this is a big mistake, raising rates, and I think it's going to be a bigger mistake if Powell keeps talking about it. Anyway, that's it for me. I do want to just mention earnings spotlight real quick. Tesla reported, there were some others. Tesla was down about $8, $9 after hours. They did beat. I just don't know in this environment that we're going to see a whole lot of movement to the upside. And then 3 you must see, I'll just say Hess Corp. Here, we did have a pullback maybe to the 20-day. It's in the energy space. I looked at energy and consumer discretion, or excuse me, consumer staples to find stocks that maybe are doing better on a relative basis, but have pulled back. Here's Enerplus 20-day test. And the last one I had is Mo Altria Group pulling back to test the 20-day there. Those are some that you might consider. Anyhow, that's it for me. I appreciate you tuning in. It's going to be a crazy few days ahead. Be careful, everybody. Be back next week at Earnings Beats for your next trading places live. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.